Hey guys, happy holidays. Hope you guys are doing great. Hope the family is good. So I'll just jump right into it and kind of share what's going on in the market and give you kind of a market update. So let me go ahead and swap over here. So yeah, recently payroll and wages economic indicator was released. So the Federal Reserve has been watching this because they want to kind of increase unemployment to bring down prices of everything, because I mean they feel that wage increasing wages are one of the causes of inflation, right? Because workers, they get paid, they earn higher wages, now they can go out into the market and buy these items or whatever commodities at a higher price due to inflation, right? So yeah, non-farm payrolls, which is just basically non-agricultural jobs, increase 263,000 for the month, while unemployment rate remains low, 3.7%. So why this is important? I mean, you would think this is a good thing, right? The job market is strong, it's growing, and so forth, right? However, the Federal Reserve, again, they're watching this indicator as a potential guide whether to continue increasing interest rates or not. So while the job market remains strong, Federal Reserve is going to take it as a cue to continue with their rate increases. So yeah, the report that recently came out shows a strong market, and this is not what the Federal Reserve currently wants to be seen, because they've one of the things they're saying is again that higher wages are leading to higher inflation because people can now go out there and afford to pay higher prices for things. So one of the things that I was kind of looking into recently, and then you can kind of see here the Fed funds rate is just blown up since earlier this year, and that's on their basically their pledge to fight inflation. It's it's gone from almost near zero. It's currently at 3.78%. And there's an upcoming Federal Reserve FOMC meeting, and they advise that they're going to raise rates another 0.5, another 0.50%. So another 50 basis points. So that's something to watch. And yeah, on another crazy note, I was kind of looking at the national US debt, and currently sits at $31 trillion, which again, increasing rates puts pressure on this kind of stuff, leading to some kind of potential systematic issue, right? So I was looking into the past, and national debt in 2006 was $10 trillion. The US had a $15 trillion economy in 2009. So it just gives you an idea how dramatically that has exploded throughout the years, right? So it's crazy to see where things are going, and basically that makes sense because if you look into current credit card debt for US households, you could see that never has there ever been this much credit card debt in the United States in history, up till now. And then this kind of gives you an idea that potentially we're going to see the end of a big credit cycle. And because think of it this way, right? Easy, lower rates, easy money makes it easier for borrowers to go out and buy things on credit and loans and so forth, which leads to economic expansion. It leads to people being able to buy more than they can afford, leads to more growth in gross domestic product and so forth. However, when credit dries up and banks no longer want to take the risk, or they stop lending that credit, now you have a contraction the other way around. So here you can kind of see the big drop in credit that was when the COVID lockdowns happened. And then again, the surge because of the low interest rates and basically stimulus checks and all that kind of stuff. And now we're just seeing basically people are not cutting back on spending. They continue using the credit cards, they continue racking up credit card debt. And when I mean, at least throughout history, whenever the end of a big market cycle comes, is usually linked to the end of a big change in the credit cycle. So that's kind of scary because one thing that I like is basically like Mark Twain said it, history does not repeat itself, but it rhymes, right? So it's kind of crazy to see, that credit card debt has never been this bad. So instead of people, cutting back on spending, adjusting their lifestyles and so forth, it seems that they're not doing that. They're using credit card to continue that lifestyle. So yeah, let me just swap over here. And it's a scary situation, kind of see all the things that are going on. It's just not one thing, it's a bunch of things. And then I keep looking into the banking sector, right? Because panics always happen, or when they truly become panics, it's because the banks um start getting hit. And banks are like dominoes, right? They're interconnected with one another because they lend to one another and so forth. So when the banks start getting hit and they start getting in trouble, which in this day and age, due to regulations and the consistency of banks throughout history causing these panics, regulations have gotten stricter. However, banking institutions are smart. They find ways to get around through all those regulations and so forth. So again, Credit Suisse, I mean, I'm surprised they're not bankrupt. They seem to have found a Saudi investor that has put some money in them. And they're basically just cutting costs and so forth. And they created a spinoff, I believe, called First Boston Bank, which typically when banks that have been in trouble do that, they create a spinoff to kind of remove the bad loans and all that, and then just throw it away with the spinoff, and then they remain. So it's called Good Bank, Bad Bank, and then they keep the good assets and so forth on the main business. However, that doesn't separate them from the potential bad situation that can occur with the spinoff, right? So yeah, Credit Suisse, I'm surprised they haven't filed for bankruptcy. They continue cutting jobs. And basically what's helped them stay afloat recently is they found a Saudi investor that put some money into them, right? And basically they're saying they're reducing costs to hopefully not have to lay off as much people. But if for some reason some kind of bad economic situation occurs to Credit Suisse, they're just like literally one hair away from filing from bankruptcy. From what I've been seeing in their finances and so forth. And why is that important? Because Credit Suisse is a massive global investment bank. They are considered one of the too big to fail companies, meaning that they are systematically interconnected throughout the global financial market. So that's kind of like goes back 2008 when all these certain investment banks like Lehman Brothers and Bears got in trouble, and AIG, the insurance company, got in trouble, and they had to be bailed out. Why? Because they are so interconnected with the global financial, or they were so interconnected with the global financial market that if they were to fail, it would be basically some sort of economic collapse. And I'm not quite sure what that means with Credit Suisse. They might have to get bailed out or something like that, because they are considered one of the too big to fail institutions, right? And yeah, so Credit Suisse, one of the banks I've noticed is in trouble. Another one is Silvergate Capital, which is basically because they were involved in the whole FTX meltdown. And so Credit Suisse and Silvergate have been seeing capital outflows. That basically means that people that have their money deposited in the bank, whether checkings or savings, are withdrawing their money out of the bank. They're leaving the money. When this happens to an extreme is what is called a bank run, right? Because now it puts a lot of pressure on the bank. They're gonna have to liquidate certain assets and so forth to meet the funds that they owe their customers, right? Because banks are typically leveraged. They leverage out whatever money you put into your savings or and so forth to make loans and get interest off of that. So yeah, FTX collapsed. I was looking more into it. They collapsed because they were trading with customers' funds without their permission. So they were trading I forget the name of the hedge fund, Alameda or something like that, was using customers' funds from FTX to trade in leverage instruments, and they lost a ton of money and they collapsed, right? And along with it, certain pensions that were invested in this, and a lot of clients lost all their money in the span of a few days. So within that storm was caught Silvergate, and basically they've just been plummeting. Their stock has been plummeting ever since, and they have been seeing outflows, meaning customers are going to the bank and removing their funds from the bank, which this to an extreme, if it can lead to an extreme, it can be a bank run. And bank runs, you don't want to see them occur anywhere because it's like a virus, is a contagion. That's what causes panics, right? So one thing I was looking into, and I like looking back into history to kind of get an idea what happened in the past and so forth, that might in some sort of way give you a clue to what can happen in the future, right? So in early 2009, in early 1928, quite a big difference there. In June, in December, and in February, and in March 1929, it seemed that the end had come. On various of these occasions, the Times magazine happily reported the return to reality, and then the market took flight again. So in 1928, 1929, market became very volatile, right? Had lots of up and down swings. However, every upswing, the news was covering, or people thought that the worst was over. And then, of course, October 1929 occurred, and it led to one of the greatest financial crises in our history. So it's interesting to see that. Why I say this is because earlier this year, it began very bad. The market began very bad, right? Because of the Russian war and so forth. And typically, the beginning of bad years in the market tend to signify potential higher volatility to come in the future. So potentially, maybe something is more volatility is going to come in. Depending on how the year begins. So that's why I'm curious to see how 2023 begins. If it's a very volatile year, it could be a sign that things are potentially going to get worse throughout the year. And yeah, since I was kind of going into the outflows for Credit Suisse and Silvergate, this is why I bring into the fact that it can become a contagion if it does, in fact, become a run, right? So in a panic, runs on a few institutions soon become contagious. Contagion can occur through several channels when bad news about one institution emergence. For example, depositors naturally wonder whether other institutions with similar asset holdings or business models might be in trouble as well. Also, financial institutions are interconnected, regularly lending to each other and transacting through a variety of business relationships. Consequently, like a row of dominoes toppling, one institution failure may cause others. So, and that being said, you never want to see runs occurring anywhere because runs are like a virus, they're like a contagion and may potentially cause fear or panic in the market, right? Best way to kind of put it. Another thing I was kind of looking into that I found pretty cool, and I wasn't familiar with this indicator, the TED spread. So the TED spread is basically the spread between the interest rate on short-term bank-to-bank lending and the interest rate on comparable treasury securities. So this is known as the TED spread. So basically the TED spread is the difference between similar treasury security interest rates and bank-to-bank lending interest rates, which are typically done on LIBOR, the London interchange bank rate. I forget the exact name of it. So I was looking at this, and it's interesting that whenever the TED spread increases, it's basically economic crisis. So it's super interesting because I was not familiar with this indicator. So you can see here, this was like basically the Great Depression of our time, 2008. That's when all the banks were like going through panics and bank runs and all that were occurring, when Lehman went bust and Bear went bust, and AIG was in trouble and so forth. So you can kind of see when this thing gets out of control, we're really in a full-blown crisis, kind of like you can see here back in the dot-com bubble era, the 2008 housing crisis, and then the COVID crisis, which was basically just a little blimp because Fed stepped in, lower rates, bailed out the market, right? But I'm curious how much of that bailing is going to come back, right? Because the Fed is not currently on the market side. The Fed is against the market. They're raising rates. But yeah, I find this as a really cool indicator, because when the TED spread spikes, that is some sort of panic going on in the market, right? And then on another note, in terms of real estate prices, so I was kind of thinking about this for a while now, because COVID happened, and then suddenly short-term rentals blew up, such as Airbnbs and so forth, and that really caused the surge. It was one of the reasons why there was such a surge in housing prices and rental prices specifically, right? Because Airbnbs had short-term rentals basically, boom, increased the rental prices overall. So yeah, COVID happens, Fed drops rates near zero, stimulates market, causes a housing boom, as specifically short-term rentals, right? They are really popular as of now still, and they were really popular specifically shortly after the pandemic, because people were like really looking to travel and so forth after being locked down. So what has been going on in the Airbnb market and so forth is demand for Airbnb rentals or short-term rentals have been dramatically dropping. So and this was kind of what I was saying, the number of available short-term rental listings in the US skyrocketed to 1.3 million in September. That's a 23% year-over-year increase, according to analytic firm AirDNA, which they have some good data if you want to check them out. So basically, the increase in supply in the housing market is putting pressure on the Airbnb market. And so according to this report, there's a lot of Airbnb homes currently sitting vacant, basically, and the the demand for Airbnbs have dramatically dropped in terms of people going out there and renting them, right? So that's basically what this report goes into. So host complainings of low bookings weren't imagining things. Occupancy rates fell in 31 of the top 50 largest US short-term rental markets from July through September, according to AirDNA. Markets where supply had grown by more than 50% had an average occupancy decline of over 10% and saw revenues drop 8%. So basically, the Airbnb market is currently downtrending. And when I say not, and when I say the Airbnb market, I mean homeowners that have Airbnb rental properties, right? Because not a lot of people, depending where they are located, I don't know exactly what states this is occurring, but it seems that demand for Airbnb rentals are declining. However, Airbnb, the company itself, is making money. That's kind of what this report kind of goes into. But they are advising that demand for short-term rentals are dropping. So kind of to show you a little bit in terms that you can see with your eyes. Let me swap over here and share with you some stuff that I was kind of looking at that I found a little freaky, right? So I like looking into like, historical charts and all this kind of stuff. And this is basically the 1929 1930 Great Depression, right? This is the Dow Jones Industrial Average. You can kind of see the massive spike this thing had throughout the Roaring '20s and so forth, when speculation basically was crazy and out of control. And then the decline began, right? But if you think about it this way, the first big drop from 1929 to I don't know what 1930, and then the bounce, you would have thought, things are good, things are great. But you can see that this wasn't just a straight down drop. This thing had rallies, drops, rallies, drop, rallies, drop, rally, drop, rally, drop, rally. So I mean, you can see that there's big rallies when bear markets occur, right? The market doesn't just go down in one fell swoop. It takes time. So I like looking at this, and then I just compare it to like maybe the S&P 500, or you can even compare it to the Dow. In this case, this is the S&P 500. In my opinion, this thing's in the downtrend. You can kind of see here the peak that was in January before the war began, and then it's been dropping. Rally, by rally I mean the price increases for a period of time or whatever. So rally, drop, rally, drop, rally. Currently, it's from October to now, the S&P has rallied about 13%. Meaning if you would have traded this thing and you would have entered in October, early October, you'd be up like 13% right now. And yeah, I was comparing that to the 1930s and find it yearly freaky. On a good note, it seems somehow, I don't know if this is good, but housing prices have kind of like stopped falling off a cliff month over month for basically since like August to it's kind of like almost now. So real estate prices have falling prices have slowed down, because it was basically month over month real estate prices since March were just dropping off a cliff basically. And then is why I look into the craziness that is going on in the short-term Airbnb market, because if the Fed does what they want to do, which is they want to increase unemployment rate to fight inflation, and if they increase unemployment rate, potentially people are going to be spending less money. And we already have a situation where credit card debt is at its largest it's ever been in history, which might potentially lead to the end of a credit cycle that will then now mean that it is a economic contraction. So Federal Reserve is fighting the employment market. They're trying to increase unemployment to reduce wage inflation, right? So people can't, basically, they won't be able to afford to buy all the things that they're currently buying, which it seems that is being done on credit, anyways. But that's their goal. They're going to increase unemployment to reduce the amount of money that people have to go out there and purchase things to hopefully fight inflation that way. If that occurs, that means people are going to be spending less money on travel, less money on rentals, as specifically maybe potentially Airbnbs and so forth. And if that occurs, the people that are relying on cash flow for Airbnbs due to by renting them might potentially come into a catch-22, and they might have to sell that property. And if that occurs to a large scale, that's going to be another influx of supply into the housing market, which potentially is going to drop prices a lot further, if not lead to some kind of crazy situation, which I can't even say what that might be. So with that, I'll just leave you with a quote that I like. The fact that other people agree or disagree with you makes you neither right nor wrong. You will be right if your facts and reasoning are correct. And that is from Benjamin Graham. So thank you guys for watching. I hope I shared something valuable with you. And I hope you guys have a great and awesome holiday, and take care.